Hi, I'm Cormac Kinney, the founder of Diamond Standard. Since receiving approval to launch our commodities, they've returned 45%, outperforming gold by 40% and even the S&P 500 by 20%. Of course, past results do not guarantee anything, and markets are complicated. But many investors ask me, how do I analyze diamonds? You see, it's not every day that a $1.2 trillion natural resource becomes accessible for the first time ever. And while we have approval for futures and options, they haven't launched. So the brokers and bankers that normally analyze commodities are not focused on diamonds yet. So there's very little research about this commodity. Now that'll change over time, but means that diamonds are a unique opportunity for nimble investors who can build positions before institutions. Imagine what will happen when diamonds are added to the commodity indices. This webinar is a quick overview of the investment case for diamonds as a newly available asset. The full presentation has 24 charts and tables and references academic papers, market research, and diamond industry analysis. You can get it at diamondstandard.co/research. Today, let's walk through the highlights as you consider the diamond commodity or fund as an investment in your portfolio. The breakthrough that made this possible is the regulator-approved Diamond Standard commodity. Each coin or bar contains an equivalent sample of diamonds, so that they're equal and fungible. Like gold bars, these can be traded, and all have the same value. They're good for delivery for CME futures and funds. This has unlocked a $1.2 trillion natural resource, making diamonds accessible to investors as a store of wealth, hedge against inflation, and speculative asset. To project the demand, we look at investor holdings of precious metals. Of all the gold, silver, platinum, and palladium, investors hold at least 15% of the above ground supply. We think that investors only hold around 1% of diamonds. The investment thesis for diamonds is simple. As financial products become available, investors may acquire 15% of diamonds. That demand will equal around 10 years of production, likely driving market values. Historically, investors never held diamonds because every diamond is a little different. There was no way to force price discovery, and the transaction friction is immense. An investor could never mark their holdings to market, so funds simply could not hold them. Diamonds were never available in the investment products that we have with gold and silver. No futures and options, no exchange-traded funds like GLD, which had a huge impact on the demand for gold. Over the last 20 years, gold went up 536%, actually outperforming stocks. But without investor demand, diamonds returned 0% over 19 years. Diamonds appear to have a lot of catching up to do. In September of 2020, Diamond Standard got regulatory approval. It was front page news in the Wall Street Journal Business and Finance section. Since then, diamonds have returned 45%. Now, this is largely because mining production was disrupted by COVID-19, while consumers were stuck at home and unable to travel. Many of them bought jewelry. But also, we began buying tens of thousands of diamonds using automated market making. Commodities in general did well in 2021. The Goldman Sachs Commodity Index returned 40%. Their head of research says the case to own commodities has never been stronger. This is because commodities do well in periods of inflation, which is at its highest level since 1982. Goldman calls it a supercycle, where commodities generally rise for more than a decade. But among commodities, none of them are quite like diamonds. Historically, diamonds had no correlation to other commodities, even the precious metals. Recently, diamonds were totally uncorrelated to gold, commodities, stocks, or bonds. If diamonds are in a secular phase of position building by investors, this lack of correlation may continue. Diamonds are also an exceptional ESG story. Look around your room. Everything you see was either mined or grown, and then heavily processed. Diamonds are simply polished to become the world's most densely valuable natural resource worth over $1 million per ounce. They're extremely efficient to move and store, and diamond mining is among the least harmful to the environment. But more importantly, we believe that 85% of the Earth's diamonds have already been sold to consumers. We expect to spend billions to buy them back from consumers, what I call a social dividend. Over time, we expect to pay more than they cost you. The next several slides present the latest research about the supply and demand for diamonds in jewelry. Jewelry demand is increasing in every region of the world and is expected to grow by 2.5% to 9% per year, according to analysts. And existing diamond mines are being depleted. Rio Tinto announced 2 closures and shut down the last operating mine in Australia. Total diamond production is projected to decline by 2.2% per year. The problem is that no major diamond mines have been discovered in 20 years, and newer mines, such as in the Canadian tundra, only have lasted for 6 to 10 years. De Beers hopes to find diamonds that have washed out to sea over millions of years. We believe that diamonds are in a unique supercycle. You have diminishing supply from mines, increasing demand from jewelry consumers, and perhaps most importantly, for the first time ever, growing demand from investors. So far, we've launched the spot commodities, the coin and the bar. Now, we're launching the first diamond commodity fund for accredited investors. We're in the middle of developing diamond futures, options, and exchange-traded funds. Once you have a national market price, institutional investors will be able to build positions for the first time. Ultimately, we expect diamonds to be added to the commodity indices. This will lead institutional investors, who often allocate 5% to commodities, to add diamonds to their portfolios. This will be another major inflection in demand. In summary, right now might be a unique opportunity for smaller investors to add the diamond commodity to their portfolios. You have the potential to benefit from a commodity supercycle and a diamond-specific supercycle, driven by a phase of position building by larger investors as financial products are developed. Please visit diamondstandard.co to learn more about our regulator-approved diamond commodity or to review this entire research deck.